I just wanted make an illustration of syndication structure. So this is going to be typical how a deal is structured. It doesn't even really matter what kind of deal it is. So it could be a note deal, it could be real estate, it could be a business. Who knows? But we're going to have some kind of business entity, probably an LLC, that is going to own this investment. That LLC will be controlled by a management LLC, and that management LLC will have a manager. The manager, the control party there, is who we call our sponsor, or our GP, our general partner. Not actually a general partner, it's just a term that stuck. And then we're going to have members or shareholders if it's a corporation. These are our passive investors. They're the LPs, you'll often hear people say. And so the way this works is very simple. The manager of the LPs, houseplants, manager of the manager is going to exercise control over the management LLC. That LLC is going to exercise control over the investment LLC. The houseplants are going to put their money into the LLC. The LLC is going to invest in something, whether it's to grow a business, acquire a property, start a factory, whatever. And then hopefully we all get very, very, very rich because this investment's going to spit off returns, distributions or dividends for the GPs and the LPs. So super basic structure. But this is pretty much how it rolls. Now, maybe there's layers of LLCs. Maybe there's other things that lenders require. That's all fine. I noticed in the chat a question that says, can a syndication include several deals, or is it a new syndication for each deal? No, a syndication absolutely can include multiple deals or multiple investments as long as they're all identified. So an investment like this with a portfolio, whatever it is, properties, restaurants, notes, who knows, as long as the investors know what they're getting into, we're still in the land of syndications.
And I think the biggest thing that you pointed out is normally it just means that you're identifying what you're investing into. As you're out there marketing, talking to investors and raising capital, saying, we're going to go buy this asset or this company, really kind of helps the investors know that, you're not going to go and hopefully you won't misuse the money and go buy other assets and buy other investments. That actually is a massive liability situation, and it happens all the time. And that's one of the reasons why you do need to make sure you really know what you're doing, because people make mistakes. Raise money for one property. Oh, there was a problem. We didn't close it. So without even thinking, we went and used the money for some other project or other property. And guess what? Have gone down the rabbit hole with the SEC in investigations that it was a pretty problematic situation. So it's don't do that. If you say you're going to buy company A, go buy company A. If you can't acquire the company because of, just for talking purposes, due diligence, it didn't pan out. It didn't make sense to move forward with that opportunity. In that case, you have to send the money back. And you can always tell the investors, hey, we have another opportunity. And as long as they sign off on changing to company B, they can sign off on that. But in order to go from acquiring company A to company B, that's a very material change. Richard, what happens when you do that?
The easiest route is, okay, here's all your money back. We're just not going to do anything anymore. But maybe, this property fell through. This similar property over here looks like it might be a deal. You can go back to the investors, give them a right of rescission. You say, hey, we're not doing property A anymore. We're doing property B. Here's information about property B. You have the right to rescind your investment, get all your money back. Happy to send it to you. Or if you want to stay in and you want to do property B with us, then sign this paper saying that you approve. You've seen the supplement to the disclosure documents. You've seen the revised operating agreement and all the paperwork that goes around describing the new investment with company B or property B, whatever it is. Then we'll just roll forward. And, if the sponsor is well-liked and well-trusted, the investor's probably going to be like, yeah, okay, I'd rather be in your deal than not be in your deal. Yeah, let's roll to property B.
Well, I've got another question for you. And, you know, everybody right now is talking about roll-ups. And we're not talking about the candy roll-ups. We're talking about acquiring a bunch of companies and rolling them up together to create a conglomerate. Um, and most of the time with these roll-ups, we're targeting an industry or an area. And the question is, you know, it seems like a roll-up strategy would be best served with a syndication structure. And I know I've got some weird opinions on this. So
Yeah.
Richard, what do you think?
Um, Here's the kind of difficulty I think you might run into, and that is when you're doing a roll up, the idea usually is to roll up more and more businesses into one, so you have bigger earnings, so you can therefore resell for a bigger multiple, either to private equity or if you get really big going public. And one of the issues with going to private equity or going public is they're not going to want to see a super complicated capitalization table. So if you syndicate a bunch of investors for this business and a bunch of investors for this business and a bunch of investors for this business, and you're rolling it all together, now you've got kind of this spider web of ownership on your cap table that makes it really not appealing. So if you're gonna do that kind of structure, I think that you've got to have a plan for simplifying the cap table before your exit at that higher multiple if your business works well. So that's kind of my only, I guess, hesitation with like the syndication structure. I'm assuming you're doing one business at a time. This might actually be better with a fund. I don't know, like a fund, a pool of investors, they own all these companies that are being put together.
My thought is the best of all worlds. When getting the roll-up started for that initial acquisition or that couple of initial acquisitions, to actually tell the investors, we are going to buy this company with the plan of a roll-up as a master business plan really makes sense. And I would prefer to take that type of approach of saying, we're going to buy this particular asset with this larger business plan. And beyond the first acquisition, it is more of a capital acquisition model or a business capitalization rather than a fund or a syndication.